If you are 63, Medicare may feel like something you can deal with later. But this year's tax return may already be shaping what you pay at 65. Most retirees look into Medicare because they worry about doctors, drug plans, and monthly premiums. But for higher income retirees, there is another layer hiding under the surface. This surcharge is often called IRMAA. It is an income-related Medicare surcharge. If your income is above certain levels, Medicare can add extra charges to your Part B and Part D premiums. Part B covers doctor visits and outpatient care. Part D covers prescription drugs. So IRMAA is not a separate insurance plan. It is an extra cost added to parts of Medicare you may already need. Here is the part that catches careful planners off guard. Medicare may not look at your income today. It may look back at an earlier tax year. That is why age 63 is not just a waiting year before Medicare. For many affluent retirees, it is a setup year. You may be 2 years away from Medicare. But one Roth conversion, one property sale, or one business payout can follow you into your first Medicare bill. The mistake is not having money. The mistake is letting too much income land in the wrong year without understanding the Medicare effect. Quick note: this is education, not personalized advice. Talk with a CPA or planner before acting on anything here. Think of these as tools on your workbench. We are not trying to scare you into doing nothing. We are trying to help you pause before a large taxable decision becomes permanent. The rules are written to confuse you, but we're here to decode them together. The simple idea is this: for high-asset households, Medicare is not only a health insurance conversation. At age 63, Medicare planning may begin with your tax return, not with a Medicare brochure. That is where the trap begins. Your tax return does not explain how it may affect future Medicare premiums. Let's make this real. Imagine David and Susan, both 63, newly retired, with a taxable portfolio and a rental property they are tired of managing. They sell the rental property, realize a large capital gain, and also consider a Roth conversion to reduce future taxes. A Roth conversion means moving money from a traditional IRA into a Roth IRA. That move usually creates taxable income in the year you do it. That does not make Roth conversions bad. It simply means the timing can matter near Medicare age. Each move may make sense by itself, but together, in the same calendar year, those moves can create an income number Medicare may notice later. 2 years later, David opens a Medicare notice and says, "But we are retired now. Why are they using that old income?" I know that sounds frustrating. The decision felt like retirement cleanup, but Medicare may treat it like a high-income year. This is why the age 63 tax return deserves a special review before the year closes. The real issue is not the Roth conversion itself. The issue is doing it without checking the Medicare income year. It also does not mean you should never sell property, stock, or business. It means the timing needs to be intentional. Here's the question I want you to keep asking. Will this income show up in a year Medicare may use? That one question can change how you sequence Roth conversions, capital gains, deferred compensation, and retirement withdrawals. Deferred compensation simply means money earned earlier, but paid to you later, often after retirement or after leaving an employer. For some retirees, that delayed payout can create income at exactly the wrong time. For households with strong savings, rental property, stock options, or a business exit, Medicare stops being just Medicare. It becomes a retirement income planning issue. Let me pause here. You can be financially successful and still feel blindsided if nobody explains the look-back rule early. Most people are told to think about Medicare at 64 or 65. But the income story may already be forming at 63. That is why this video is not really about picking a Medicare plan. It is about protecting the income years before the plan begins. Medicare is the doorway that brings people in. The surcharge is the hidden room affluent retirees need to understand. If you are 60, 61, 62, or 63, you are not early. You may be right on time. Before Medicare starts, there may still be room to spread income, delay income, accelerate income, or document a change. The first problem is that retirees often use the word income too narrowly. For IRMAA, income can include wages, interest, dividends, capital gains, pensions, IRA withdrawals, Roth conversions, rental income, and business income. So a household can feel retired, live conservatively, and still show a very large number on a tax return. That is especially common when one-time events land in the same year. Here is where careful retirees get caught. They think this was just a one-time event, but Social Security may still read the tax number. Social Security usually uses IRS tax information from a prior year to decide whether the surcharge applies. David and Susan did not feel rich when they sold the rental. They felt relieved because the property had become a headache. But the tax return did not say relief. It showed a capital gain. Then they looked at a Roth conversion, because the years before future required withdrawals from retirement accounts can be valuable. Those future required withdrawals are often called RMDs. The plain English idea is simple. At some point, the IRS eventually requires taxable IRA withdrawals. That advice can be reasonable, but the size and timing matter. A property gain, plus a Roth conversion, plus portfolio income, can turn one cleanup year into a high-income year. Let me say that more plainly. Medicare may not separate those decisions emotionally. It may simply see the combined income number. The problem is not bad decisions. The problem is crowded decisions. This is the part I would circle in red. Too many good moves in one year can create one expensive-looking tax return. Crowded income years can turn a smart plan into a surprise premium problem. The second problem is that Medicare timing and tax timing are often handled by different people. Your CPA may focus on the tax return. Your advisor may focus on investments. Your Medicare agent may focus on plan options. But IRMAA sits right in the middle of all three conversations. If nobody owns the middle, the retiree becomes the messenger. And that is not fair to you. You should not have to translate tax rules, investment strategy, and Medicare premiums by yourself. The household needs one shared calendar, not three separate opinions living in three separate folders. The third problem is waiting until the Medicare card arrives. By the time enrollment begins, some of the income years that matter may already be closed. This is why age 63 matters so much. Once December 31st passes, that tax year becomes history. You may still have options later, but you may have fewer options than you had before the year closed. The fourth problem is assuming an appeal can fix everything. In some cases, a qualifying life-changing event can support a request for a new review. Retirement, loss of certain income, or other qualifying changes may matter. But not every high-income year is treated the same. A planned asset sale is not always the same thing as a true income loss after retirement. That is why I would rather help you review the year early than sort through paperwork after a notice arrives. Documentation helps, but timing helps even more. The fifth problem is that married couples often have two Medicare timelines and one tax return. One spouse may be 65 and entering Medicare, while the other is still working, consulting, or receiving business income. So one person may say, "I am retired," while the household tax return still says, "This is a high-income household." That mismatch can feel frustrating if nobody warned you ahead of time. Now let's turn this into a practical 3-part map you can actually use before the next big income decision. The Medicare Surcharge Protection Map has 3 parts. Map the years, project the income, and coordinate the decision. Part 1 is Map the years. Start by marking age 63 in bold. Add ages 64 and 65 next to it. Then mark which tax years may be reviewed for future Medicare premiums. Once you see the years on one page, the rule becomes much easier to understand. The timeline helps you see whether this year's income may show up in a future Medicare decision. I would circle this in red. Age 63 is not just another year if Medicare is around the corner. It may be the year that quietly shapes your first Medicare premium experience. Part 2 is Project the Income. Do this before you make the large taxable move, not after the tax return is filed. The income number is called MAGI-EE. It means Modified Adjusted Gross Income. In plain English, it is the income number Medicare uses from your tax return. It is not your net worth, and it is not how wealthy you feel. It is a tax number, and that tax number can matter. Ask your CPA or planner for a rough projection before the year is almost over. You do not need a perfect forecast. You need enough clarity to know whether you are building a risky income year. Then list the income spikes before they happen. Look for Roth conversions, capital gains, rental property sales, business payouts, deferred compensation, bonuses, IRA withdrawals, and large dividends. The plain question is this: does all of this need to happen in the same year? Sometimes the best move is not avoiding income. It is spreading income across years with more care. A Roth conversion should be compared against taxes, future required IRA, withdrawals, estate goals, cash flow, and possible Medicare premium impact. If this were your tax return, I would want the Roth conversion sized, not guessed. The question is not, how much can we convert? The question is, what result are we buying? Part 3 is Coordinate the Decision. This is where the plan becomes practical. Separate one-time income from recurring income before you decide what to do next. A one-time sale may create a temporary IRMAA issue, while ongoing income may require long-term budgeting. Temporary spikes need timing and documentation. Recurring income needs expectation and planning. Coordinate both spouses on the same page. Write down both birthdays, Medicare start dates, Social Security timing, pensions, work income, and planned taxable events. This is where many couples find the missing piece. The Medicare spouse and the working spouse are still connected through the household return. One household income number can affect one or both Medicare premium conversations. Prepare an IRMAA folder before there is a problem. Keep retirement letters, pension changes, employer separation notices, tax projections, Social Security letters, and CPA notes in one place. If your income drops because of a qualifying life-changing event, organized paperwork can make the Social Security review process less stressful. When the paperwork is ready, the phone call feels less like panic and more like a process. Schedule a pre-December income review. Review realized gains, planned conversions, charitable giving, business income, and any income you still control before year-end. December should not be the first time your household thinks about IRMAA. By then, some choices may still exist, but the room to maneuver is smaller. And if the surcharge still makes sense after the review, budget for it and move forward. It is much easier to accept a cost when you knew it was coming. Before every large taxable move, ask this sentence: will this income affect my Medicare premiums later? That sentence is small, but for the right household, it can protect thousands of dollars and a lot of peace of mind. Now let's give David and Susan a better ending. Before selling the rental and doing a large Roth conversion, They schedule one joint review with their CPA and advisor. They realize the rental sale already creates a high-income year, so they reduce the Roth conversion instead of stacking both moves together. They still simplify the rental property problem, but they avoid turning one year into a bigger Medicare surprise than necessary. That is what good planning looks like. Not fear, not avoidance, just better sequencing. The same financial decisions can produce a different outcome when the order is chosen carefully. If you are 63, your next step is simple. Pull your tax return and circle every item that could repeat, grow, or spike. Look for capital gains, IRA, distributions, Roth conversions, rental income, business income, interest, dividends, and one-time payments. If you are 64, look at last year and this year before you make another major income move. You may not be able to change the past, but you can still prepare, document, and make better choices going forward. If you are already on Medicare and received an IRMAA notice, do not ignore it. Read which tax year was used, check whether the income is accurate, and ask whether your current situation supports a new review. If the income was planned, learn from it. If your life truly changed, document it. Either way, the answer is not embarrassment. The answer is better information. The rules are written to confuse you, but we're here to decode them together. And decoding them starts before the year closes, not after the premium notice arrives. For affluent retirees, the real Medicare blueprint is not just choosing a card. It is knowing which income year you are building before Medicare looks back. High income is not the problem. Uncoordinated income is the problem. A strong retirement plan should know when Medicare is watching. Please like this video if it helped you see the age 63 income trap more clearly. Liking the video helps more retirees find this before a surprise Medicare notice lands in the mailbox. Subscribe to Tom's Medicare Blueprint for calm, plain English guidance on Medicare, IRMAA, and retirement income planning. This channel is built for retirees who want straight answers without scare tactics. And comment PROTECT if you want a follow-up video where I walk through 5 real-life income events that can accidentally trigger IRMAA. The word PROTECT tells us you want practical examples, not generic Medicare talk. Before you go, remember the order: year, income, decision. First, identify the year Medicare may review. Then, estimate the income. Then decide what move belongs there. Bring your CPA, your advisor, and your Medicare planning into the same conversation. One shared calendar can prevent a lot of confusion. You do not have to master every IRMAA bracket to protect yourself. You just have to ask the right question before the income year closes. Will this income affect my Medicare premiums later? For the right household, that question can change the entire retirement income conversation. Protect the years before Medicare, and Medicare will feel much less surprising when it arrives. This is Tom's Medicare Blueprint, helping you plan Medicare simply, clearly, and with care.